data on the network. So that's both looking at actual performance on the network, so collecting actual transaction records, understanding that in the context of other data sets, things like road coverage. So if somebody's commuting, is there a certain point on that commute route where they're going to get a worse experience? And then all of this, people are obviously starting now to plan for 5G networks, Internet of Things. So in terms of the number of use cases we're going to see and the volume of data we're going to see, everything is going to be getting exponentially bigger. So the kinds of benefits that customers get by having this centralized view of the network, a single view of the network, is that they can hope to increase the quality of the service. They can help to increase that Net Promoter Score because they can target the most valuable customers and make sure that their experience is good, not just for where they live, where they work, but also any typical commute distances and road network that they use. It helps reduce churn, and also it may be able to help pinpoint areas where they could acquire customers where a competitor may be weak in a particular area. So in terms of how do we relate all this information, one way of looking at this is to start producing a gridded network that allows us to relate different data sets and also to spatially bin point data, transactional data, so that we can start to aggregate within a particular grid cell and understand what the average experience or the worst or the best experience is for that grid cell. So the approach for the telecommunications companies is to favor a hexagonal type of grid system. This is based on the way that people think. So if you think about a typical cell tower radiating out in all directions, and then next door is another cell tower, next door is another cell tower, you start to make up this sort of honeycomb picture, and that's kind of the way that those kinds of customers think, because that's the nature of their business. I think other industries might have less of a strong favour for hexagons, but certainly for the telecommunications people it's sort of natural to the way they think. So obviously we want to preserve some of the integrity of the original data sources. There may be data coming from probes on the network, which is a different resolution kind of data set to triangulated data coming from cell towers. So in order to preserve some of that, we can create a grid which is in a hierarchy so that we can store data at the level at which it was collected. Also, then we're getting these point data sets, and we're able to then say which hexagon ID each piece of point data relates to. So we would take that hexagon, we would take a transaction record, in this case a call, and then we would apply any kind of data quality. We would be able to spatially process that and be able to start doing some kind of analysis. The benefit of being able to use this kind of hexagon approach is that we could put whatever data sets we want into that analysis. So in the telecommunications example, we might use street networks to start looking at commute patterns. We might want to understand information about points of interest or businesses that are nearby a particular location. We might want to look at start or end locations and use those as proxies for where certain kinds of customers live, and then start relating that to demographics. So in terms of the actual coverage maps that the telecommunications company is producing, we can take all these different variety of data sources, but then using these common grid IDs in this hexagon grid, we can then start storing that data, and we can build what we would call a customer verified coverage map. So in the past, Pitney Bowes would have helped customers with different kinds of RF planning tools that actually use predictive models to work out, based on the position of cell towers and known parameters and equations that govern how radio waves propagate, and information about building clutter or land use type, to start creating these predictive coverage models. Whereas today, with being able to get much more with that being able to handle the volume of data that's produced by all the devices on the network, you could actually say, well, rather than predicting and using the predictive model all the time to tell people that's our coverage, well, now we can start using the real data that is people's actual experience. So in terms of being able to take all of these different layers of data and combine them, you can then use that to solve different problems. So for each company or for each kind of industry, customers are going to be using different kinds of data sets and combining those together to solve different kinds of questions. I think this approach is really saying, well, you centralize your data, you have a common system of reference for that data that allows you to associate different data sets, and you can also aggregate data together using that same system. And that makes it possible for companies to optimize their networks, for them to be able to create these new data products, and then they can use that within any team, whether it's marketing or sales or any of the different teams within a wireless telecommunications firm. Back to that sixth V, I think, maybe the seventh V, visualization. People are visual, so when somebody walks into the store to find out, do they want to switch provider, people like to see evidence of, well, I see your adverts on television, you tell me I have great network coverage, well, what does that really mean? A visual representation of that where you can say this is not just predictive values, this is confirmed customer values from the network, really obviously helps people to visualize that. People are probably better at pattern recognition in a visual sense than machines are. Another kind of use case in this example, looking at coverage in the sense of it may be important to know where someone is at a more precise level, so are they inside a building or outside a building. It might be interesting to me to know that somebody was in my store, but say I'm Macy's and I have a large parking lot and I'm in a shopping mall and across the street there is another store that's my competitor, or alongside me there's a store that's my competitor. It becomes important to know where somebody accurately was, were they inside a geofence or outside a geofence. In terms of our solution for this, we've really started thinking about a layered approach. We have our own data sets that we sell that are enabled for big data environments, and then we have core components that are Java-based SDKs and APIs that allow us to do the spatial processing, geocoding, data quality. And then above that we have some functionality that is specific for the MapReduce or Spark environment for Hadoop. And then in addition to that, obviously we have the hexagonal grids that allow people to do the spatial binning and application-specific code. So moving on to another industry that's one that we work with a lot, which is property and casualty insurance. Here, the main business driver is a thing called the combined ratio. So in property and casualty insurance, whether a company makes money is really defined by how many losses do we have, what were our expenses and our running costs, and then how much did we earn from all that money that we took off you and invested on the stock market. So if you have a combined ratio that's above 100, everything's good, and if it's less than 100, everything's not so good. So looking at different ways to improve the combined ratio is something that obviously insurance companies spend a lot of time doing. And in times when the stock market is good, nobody really worries too much about how much you lose or what the real expenses are. And in times when the stock market is bad, then people worry a little bit more about those things. So in terms of taking that kind of big data view and applying it to property and casualty, it's really about looking at more and more parameters that may affect that loss piece of the equation. So looking at a better understanding of the risks associated with taking on a particular property and adding that property to an existing portfolio of properties, and understanding what is the true risk of any kind of different natural event occurring that might affect that property, whether that be a hurricane or a flood or a hailstorm. So some of these risks are better understood than others, and they all have different time frames that people have to worry about. So the companies need to worry about predicting what the overall losses from a particular event might be. In the case of a hurricane, you may have 24 hours in which you have to report to the stock market what you think your losses due to an event may be. So being able to sort of work out all of these things very quickly becomes very important. The other element is at the other end of the scale. If you think about something like a hailstorm, somebody may not even notice that they have roof damage from a hailstorm for some period of time. So again, being able to calculate how much money they need to reserve for a particular event having occurred, and also being able to verify false claims so that they're not paying out for new roofs that were nothing to do with a particular hailstorm, but just because somebody didn't repair their roof for 20 years. So again, we're taking all of these different data sources and we're needing some kind of way of tying together all of those disparate data sources and be able to make sense of that. And this is something that we've been doing as a company using kind of traditional methods for a long time. The new way of thinking about that is we've been looking at something called master location data. So this is the idea that a particular property would take on an ID which wouldn't change through time. So we would use all of the smarts that we have in our addressing to understand from an address what is that location of that address, and then be able to use a key for that address to tie it to other different kinds of data sets about the property. So this geocoding process we have now for the US, and it's going to be going to other countries, looking at taking all of those addresses and using a variety of different data sources in order to tie that to coordinates on the Earth's surface. And then being able to use that not just as a point in space, but also the actual physical extent of that, the parcel boundary, so the building, and also the area of land around that building.
About 3 minutes.
3 minutes? Okay. We might not get to financial services. So in terms of big data, we've been using big data processing within our own data teams now in order to process these records and be able to create these kinds of data sets that are pre-created. So this is the idea that property and casualty insurer maybe doesn't actually want to have their IT team become specialists in GIS or specialists in the special processing that's needed, coping with new data sets coming in, maybe quarterly data updates. So instead, the idea is that with the master location data, that we really provide the answer. We give you, for your addresses, for your properties in your portfolio, here is not just the definitive location of that property, but also all of these different attributes for that property coming from numerous data sources. And you can start to extend that thinking to really generate data sets that previously weren't possible. So value-added data sets is combining many different sources of data and then providing a product that's kind of the sum total of all of those different data sets. So here, fire protection data set, which is combining both the location of an address, but then also the location of fire stations, being able to use routing to say, well, which are the nearest fire stations, how far away are they, where is the nearest water body. You can look at fire hydrants, you can look at all different, what is the distance to forested area. There are all different kinds of components that you can start looking at in terms of data sets that may tell you something extra about your risk of being hit by fire. So probably 1 minute to talk about financial services. So just looking at one area in financial services, so looking at transactional data and using that to think about the problem of fraud. So imagine my credit card is used in multiple locations within a day. How can we start working out which ones of those may be fraudulent based on location? So here looking at a source point, the first transaction maybe, starting to create ISO lines around that based on time, drive time distances at particular times of day, and then understanding if it's even physically possible for me to have been in all those different places at once. Okay, thank you. Any questions? Yes.
That was an excellent. Did I? Oh, there we go. Okay, yeah. That was an excellent presentation. One of the things I particularly liked about it is you dealt with data that's not commonly thought of as having a spatial attributes to it. Financial data, insurance information. It's that contextual information. And that's an important thing for sort of bringing data together. My main question though is on your grids. Are you building sort of kind of ad hoc hexagonal grids, or are you building global grid structures?
So it's a global grid structure.